Hello, everyone, and welcome to our BKL 2025 budget briefing webinar. Thank you all for joining us in record numbers. I'm Anthony Newgrosh, and I'm delighted to be joined by two learned colleagues. Hello, Stephen Baker.
Hello, Anthony, and good to see you, and welcome everyone.
Nice to see you too. And Neil, who's our private client partner, or one of our private client partners, I should say. Hi, Neil.
Hi, Tony.
Nice to see you both, and thank you for joining us. Although I have to say, I think I'm looking the happiest on those pictures. I think you'd all have to agree. So much to talk about. Forgive us if just a quick word of indulgence, a little bit about our good selves at BKL. We're now up to, I think it's 450 people, and we've even now got an office in Cardiff, haven't we? So we've got North London, City Office and Cardiff. We're B certified. We're part of the DKF network, we're proud to say. And we are a top 40 accountancy firm now. So that's, well, more than enough about us. Thank you for joining us again. Plenty of old friends with us today. Let's just dive in with our budget headlines. What happened yesterday? Well, we could sum this up as we're all doomed, but looking at it all in a bit more detail, we've got, I think, the heavily trailed to a certain extent, the additional 2% income tax surcharge on most investment income, not quite all, as Neil will explain to us later. Stephen's going to talk us through the changes to salary sacrifice and pensions that I think we were all expecting. Further freezing of allowances for 3 years. The so-called mansion tax on houses worth more than £2 million. But there was a little bit of good news in there yesterday. There's some improvements to the EMI and EIS share schemes, and probably not tax, but I think worth mentioning, there's the scrapping of the two-child benefit cap that came out at the end of the budget yesterday. So those are the headlines. Stephen, just looking at it in the round, what are your sort of overall impressions of the budget yesterday?
The big takeaway for me is what that second bullet point is there around salary sacrifice. I've spent a significant part of the last 10 years of my career implementing these types of arrangements. So to be told in an announcement over the budget briefing yesterday that we've got to unwind those the next 3 years, my heart sank a little bit, but it will be keeping me busy. But the serious point is it's going to have a financial impact on employers and employees, but most importantly, their pension fund and ability to save for their retirement. So we'll get more into that later when I start talking through how it's going to work. But that was my big takeaway.
And albeit a bit of time to plan for that. Neil, from your perspective, the winners, the losers yesterday?
Yeah, I mean, look, the economic outlook painted by, well, not only Rachel Reeves, but the OBR is pretty dire, to say the least. With that being said, with all of the potential mooted changes, rumours, leaked information over the last 5 to 6 months, I think it's fair to say that most of my clients would probably consider themselves marginal winners as a result of this budget, because obviously there are deeply entrenched concerns around potential estate planning changes, potential exit charges from when leaving the UK. Up until a couple of weeks ago, there almost certainly was a 2% income tax increase across the board for higher rate taxpayers, which for various reasons was no longer needed in the actual budget itself. So, it's not really a case for me of winners or losers, but I think in general, most people would say it could have been a lot worse for individual household finances.
Yeah, I think it could. It's worth bearing in mind that I think this takes the tax take up to 38% of GDP, which is a record, Neil. Are your clients sort of queuing up at Heathrow at this point?
No, look, I think for the most part, the damage has already been done. It's fair to say that I think most advisors in London have seen a swathe of individual clients leave the UK, not just this year, but over the last 2 to 3 years. That's really disappointing. It's very depressing in many respects. Has this budget done anything to stop that trend? Well, those individuals that were very concerned about specific things like an exit tax or inheritance tax rules changing imminently may choose to remain in the short term, but the general economic outlook and the general malaise in the UK has not changed. So I think we are probably in general still going to see a general shift away from UK shores in the short term in general.
Okay, well, in true OBR style, probably most of you have seen what we were going to cover about 40 minutes ago, but just in case you didn't, we're going to talk you through the income tax and employment tax changes. Neil's going to highlight some smaller changes on trusts, inheritance tax, and we'll say a few words on CGT. We'll then have a brief gander through business taxes and some of the anti-avoidance changes that were announced yesterday. Property, once again, HIT, we'll talk about that. And then we'll just cover off some of the VAT changes. Before we dive in there, I guess just a little bit of housekeeping. If any of you have any questions as we go along, do feel free to put those into the Q&A box that you hopefully can see along the top of your screen. We'll do our best to answer some of them as we go along. Apologies if we can't cover them all. But when we send you a copy of the slides and a link to this webinar afterwards, if there are any questions we've missed that we think are of general interest, then we'll try and pick those up then. If any of you ask too difficult questions, though, we will put the Deputy Speaker onto you. And I think we'll all agree she was the real star yesterday, wasn't she? She was brilliant. Great entertainment. But let's now dive in. We're going to start with income tax and private client issues. So over to you, Neil.
Thanks, Tony. So just covering off a few sort of general points. I think it's fair to say that many of the changes in the budget yesterday they're fairly scattergun across a number of taxes. There were no sort of pervasive general principles, but I've just covered off a few from an income tax perspective here. It's worth just setting the context in respect of the 2% rise on dividends and savings income, which I'll cover off. You know, up until 2 weeks ago, as I alluded to, it was almost certainly the case that you know, we were going to have a 2% income tax increase across the board. What is clear from the OBR is that they, you know, decided to lend Rachel Reeves a lending hand, gave her the credit for a number of things, one of which will have been some of the interest rate yield falls on in the markets in the weeks following the technical reporting day, and that's given her far more headroom, which has allowed her really to do a budget or give a budget yesterday that really helped quell some of that backbench discontent in those backbenches. So this was the budget that her party really wanted to give, whereas a few weeks ago she was having to give a budget which no one really wanted to give, but in the end she didn't really have to give it, or she's at very least deferred it. But in terms of these slides themselves, you know, what we've seen yesterday is that we are going to see a 2% increase on dividend rates, both at the basic and the higher rate, but not at the additional rate. So for those people with incomes of over 150,000, Tony has some thoughts as to why that might be, and I think the graph on the next page when we get to it might help explain that. But also savings income will also see increases in 2%, but that will also be at the additional rate as well. Any reliefs and allowances claimed in your tax returns will have to be offset against non-property savings and dividends income first, just to make that what they're trying to do there is make sure that you're not getting your marginal relief at the very highest rates of tax. And we haven't got it on the slide, but for dividends, the actual tax rates will increase at the basic and the higher rates 10.75%, and for the higher rate to 35.75%. And obviously for savings income and property income, that would be 22, 42 and 47% respectively.
Neil, if I could just interject there, I was just while waiting for this webinar, correct me if I'm wrong, but I think we now have tax rates of 10.75%, 14%, 18%, 20%, 22%, 24%, 28%, 33.75%, 39.35%, 40%, 42%, 45%. Then there's the marginal rates of tax when your personal allowance is drawn back. You wouldn't start with a tax system like this, would you? This is just getting unworkable, isn't it?
No, you wouldn't. And obviously, you know, I think it's fair to say that every successive chancellor on both sides of the political divide have come into office saying they're going to simplify the tax system. It is ripe for simplification. We have an extraordinarily complex system. The problem has been that every successive chancellor has been put in a position one way or the other where they've had to tinker in order to meet budgetary demands. And no chancellor's priority has really been simplification, given that the issues that they've had to deal with. So that is the problem. Will we get it in the future? Probably not, to be honest. There have been times in the last 15 years which have been ample times to do a bit of simplification, and it hasn't happened. So for the time being, I think we're going to continue down this line of more complex, more complexity is, that's going to be here to stay.
Okay.
So just moving on, there's a nuanced point around the non-residents from April 26. You'll no longer get a notional dividend tax credit. And what this will do is it will affect those individuals that are still taxable as non-residents in the UK because they may have UK partnership income or property income. They won't have an offset in the way the calculation works of this notional 10% tax credit that we all used to get in theory as taxpayers. This seems wholly fair to me. It's really just aligning existing UK taxpayers' treatment of dividends with non-residents. I think it was probably an omission in the original drafting years ago when the tax credit system changed, to be honest. But so if you are in that position, you may see some marginal changes in your effective tax rates as a non-resident. We have seen some ISA changes. I won't go into too much detail here because I have got another slide on these a bit later on in the presentation. But suffice to say, as is pointed out in the slides, that you are going to see a twofold effect, particularly where you're a cash ISA saver. For most individuals, apart from those aged above 65, you'll see an £8,000 reduction in your ability to save via an ISA, but equally, a 2% increase in tax rates on savings income. So to the extent that you don't use that allowance for, your stocks and shares ISA.
Okay. And I think you've just made the point there about property companies, and that may force people to change their structures. We'll cover that off a bit later when we look at property businesses in general and how they unfortunately have been hit once more. You mentioned the fact that the 2% additional income tax rate doesn't apply to dividends, and I think we were all a little bit surprised by that yesterday, weren't we, Neil? There was no obvious reason why the Chancellor would choose not to, but maybe this slide answers it. This is where we're looking at the effective rate of tax. If you own your own small business, you have a choice. You could take the money out as salary, or you could take it as dividends. If it's salaries, we've got NIC costs to think about, but what's the effective rate? How much do you end up with by the time you've got the money into your hands if you take it out as a salary or as a dividend? And as we'll see there, those yellow and green lines very much align after you take out approximately £200,000. So I think what the Chancellor may have done, and the reason why they haven't put that additional 2% on, is to align the effective rates of tax for salaries and dividends going forward. There are differences at lower rates, and this chart does highlight in the red line there, if you're simply self-employed, you might be better off rather than incorporating your business. But I think this is a much broader topic, Neil, isn't it? And we need to think about the protection a company gives you from being sued, for example. And it may be, for example, if you are running a business and entitled to R&D tax credits, then there's very good reason to take a salary rather than dividends. But did you have anything to add on that, Neil?
I agree with everything you've said. The only other points I would make are, we're certainly heading towards the wrong side of that Laffer curve where, tax take arguably in the end may well start to diminish despite the overall higher effective rates. And I think 50% is a psychological barrier. And had they done that 2% increase at the additional rate, that would have just increased effective rates just that little bit too high. And in general, the thing that Rachel Reeves kept alluding to yesterday was trying to close the gap between people structuring in different ways and trying to, at least in her eyes anyway, reduce the perceived unfairness of structuring in different ways.
All right, just a slight aside, and then we really should crack on. But as we'll see later, there's been no changes in corporate tax rates. We do see clients run family portfolios through a family investment company. Do you think we're going to see more of that? And then perhaps, obviously, if you take the money out by way of a dividend, you've still got that additional 2%, but possibly you could have a family investment company look to emigrate in the future. Neil, is there planning opportunities around that?
But I think more generally, for a long time now, in decades, in fact, individuals have used corporates, whether it be as property holding vehicles, investment vehicles. It doesn't always make sense depending on what the nature of your returns are and what your sort of investment mandates are. But fundamentally, we will definitely, I think, see a continuation of the use of companies to house investment assets, as well as their general businesses.
All right, but we could advise on a case-by-case basis. Okay,
Sure.
let's crack on then and talk about allowances and national minimum wage, Neil.
Yeah, so look, no big surprises here. She had a big number to raise. It was less than she thought she was going to have to raise in the end, but this was really one of the biggest ticket items. This raises over 8 billion for her. It causes significant fiscal drag, and this is the freezing of the personal allowances, which were already frozen, have been frozen since 2021. We're already frozen by the previous government up to, through to 2028. They'll now be frozen through to 2031, and raises her, really does raise her a really significant sum. And that's really why she's only had to trim around the edges with various other policies that that she announced yesterday. So current personal allowance 12,570, that will remain now until 2031, quite depressingly. From 2027-28, those pensioners who previously received state pension, which was covered by the personal allowance, they'll now be subject to income tax. They'll now be subject to income tax given that state pensions will exceed the personal allowance. That's been a change that's gradually sort of crept up over the last few years. There was a question in advance of this session around how that might be dealt with. Will those pensioners that are in this situation or have simple investment income profiles, will they all have to file tax returns? The answer is possibly, but there is a mechanism called a simple assessment, which isn't a tax filing as such. It's where the revenue will assess your circumstances based on the information they have, raise an assessment, issue you with a tax bill to pay, I think from memory, within 3 months, and it will prevent the need for a filing. And they will probably be getting in touch with those taxpayers very shortly after the end of the tax year in order to do that. And then finally, another tweak for individuals, age 21 and over, the national living wage will rise to £12.71 an hour. And if you move on to the next slide, Tony, there's a table which shows the national minimum wage increases. There's not a great amount to see here, save for the fact that the changes are very significantly above the rate of inflation. So going back to my point earlier, this really was a budget to satisfy the discontent in the backbenchers. Stephen, I think you probably had a couple of comments around why that second bracket was so high at 8.5% change as well.
Yeah, I mean, as Neil mentioned, these are significantly above where inflation's running at the moment, particularly that second bracket there where people aged between 18 and 20 receive the national minimum wage. The intention is that band will actually be subsumed within the one above it, and that will be the national living wage for everyone over the age of 18. It's not going to happen overnight. They want to sort of do it gradually, but that's why that larger increase there of 8.5% percentage change. It's to get there a little bit quicker. So within the next year to 18 months, we should see that those bandings increase, because we'll only have rates for 16, 17s and apprentices and everyone else on the national living wage. But that's the intention behind it, to close out that 18 to 20 bracket altogether.
Okay, thank you. And then just a couple of other points, Neil, before we let you have a lie down.
Yeah, sure. So those clients out there, or those advisors to clients that may have emigrated abroad in the more recent past or thinking about doing so, we have these temporary non-residence rules that effectively mean that for most capital gains and most forms of income, not all, but most, if you leave the UK and become a non-resident, if you return within 5 years, those income and gains can come back into the charge to tax in the year of return. It's to prevent individuals from, going abroad in the year of a very high anticipated tax bill, like a sale of a business or taking a large dividend from a company, and effectively returning to the UK the following year. There's just a tweak to those rules, which effectively now means that if you do take a distribution like a dividend from a company where the underlying profits that you're distributing arose after the period of departure, will no longer make that distinction between profits arising before and after departure on a just and reasonable basis. It will just be, any dividends really paid, throughout that, 5-year period after departure. They will be caught if you subsequently return to the UK. So don't want to dwell on that point too much, but it will catch some people. And then I mentioned earlier the changes to the ISA regime. There have been some discussion over the late summer around ISA allowances being cut. Industry bodies had weighed in, and there were some sensible conversations around how we could keep the 20k, but make some tweaks around the edges. Where they've actually landed, rightly or wrongly, is that whilst the £20,000 limit will be kept for individuals under the age of 65, only £12,000 of this can be allocated to a cash ISA, and the balancing £8,000 will have to be allocated to one or more stocks and shares ISAs. Those aged 65, for fairly logical reasons, can continue to contribute the full £20,000 to their cash ISA.
Okay, thank you. All right, Stephen, it's your big moment. Let's talk about employment taxes, and in particular, I think pension salary sacrifice changes. Heavily trailed, I guess, but tell us what's happening.
Absolutely, heavily trailed. So not a great surprise. And actually, we got an advance sneak preview when the OBR report was leaked in advance of the Chancellor's briefing, which was a rather surreal moment yesterday when we got all the headlines before she'd even taken to her feet. But pension salary sacrifice, it's long been discussed that they would be looking perhaps around the national insurance treatment of this arrangement. It's been around for a good 20-25 years, pension SALSAC, and for the most part it's been left alone by successive governments and indeed by Treasury and HMRC, because it's seen as a good thing from a policy point of view to support people in the tax and the NI system to save for their retirement. So some anti-avoidance legislation came in around about 2017, which was known as OPRA, and that closed down all sorts of other types of salary sacrifice arrangements, but it specifically left pensions alone. So it has been here for a while to allow people to save for their retirement. That being said, it is a significant revenue raiser that they're doing this. The second bullet point there refers to the 4.7 billion. This is projected to bring in to the Treasury, which is the second largest contributor out of all the announcements yesterday, the first being the freezing of the ban. So this is going to significantly swell the Treasury coffers once this comes in. So the headline announcement is that from April 2029, so that's the first bit of good news. We have some time to prepare for this. Over 3 years, 3 and a bit years, all salary sacrifice pension contributions which exceed an annual cap of £2,000 per employee will be subject to both employees and employers' national insurance contributions. So I'll just repeat that point. All salary sacrifice pension contributions exceeding £2,000 per employee are going to be subject to both employees' primary and employers' secondary national insurance contributions from April 29. And the way a salary sacrifice works in essence, conceptually, is it's an employer-only contribution. Employees are giving up a part of their pay for the employer in return to make an enhanced contribution on their behalf, because employer contributions to a pension fund aren't subject to national insurance. So by structuring it via a SALSAC in this way, the employee saves money, the employer saves money, and the pension fund gets that extra, usually that extra NIC, because a lot of the savings that are generated through salary sacrifice, employers will sometimes top up the pension arrangements, either the full amount or sometimes subsidised by half. So that will end from April 29 when this comes in, because those savings won't be available anymore. So employers need to think about if they are going to make top ups and how they're going to fund that. But the other key takeaway from this, and this wasn't in the main budget release, I had to really sort of look through in detail all the accompanying pages that get published. It's that bullet point there that talks about ordinary employer contributions, and I very specifically quoted the exact wording of the briefing here. Ordinary employer contributions will remain exempt from national insurance. So let's just explain what that means there. And I put in brackets there, not made via salary sacrifice. So if you're currently an employer that offers occupational pension, but it's not via salary sacrifice, your employer contribution, the employer element, won't be subject to national insurance because it's not considered earnings, general earnings for social security purposes. That's not going to change. And the reason that's not going to change is the largest employer in this country by headcount is actually a government employer. It's the NHS by some margin. And large civil service departments, public departments, government departments, they don't offer pension salary sacrifice. There's usually in the trust rules that underpin a lot of these schemes, often defined benefit schemes, there's a requirement that you have to have a mandatory employee contribution, so you can't restructure it via salary sacrifice. If they just change the rules so that actually all employer contributions going forward would become subject to NIC, that would massively increase the national insurance bill for government departments and effectively nullify the savings that are going to be generated by this. So that's a key part of this. And so what that means is that there is still the ability, in theory, to negotiate your terms and conditions in such a way that don't meet the hallmark of a salary sacrifice, but still keep you outside potentially the net of national insurance. You need to bear in mind that there will be optional remuneration arrangements and employment law considerations, but in theory there is almost a chink in the armour there that allows a way through potentially for pensions to be still structured in a NIC efficient way that sort of falls short of salary sacrifice. But you just need to be mindful of, I say, those OPRA rules. We haven't seen the legislation yet as to how this will work, but it's a key point there that ordinary employer contributions are going to remain exempt from NIC. It's only those that are structured via salary sacrifice that are going to be caught by these new rules.
All right, let's see a brief example. Stephen, talk us through this.
So I've modelled basically three salaries here of 50, 100, and 150k as to what the financial impact here. To keep the maths nice and simple, we've got a 10% pension contribution, which is 5% from the employee, 5% from the employer, so it's matching. So the nickable amount, so that's the amount that's above the 2,000 excess is shown there. So it's 3, 8, and 13, and then you've got what the employer's nick and the employee's nick will be at 15 or 8%. These are very much envelope case study calculations. Appreciate there's all sorts of reliefs and lower rates available, but you can see for someone, a top earner on 150k, the additional nick going through to Treasury is just shy of £3,000 through these arrangements, and even for someone on 50,000 is just sort of entering that higher rate world, just shy of £700. So there is significant nick on the table here if employers do nothing, if they are already within salary sacrifice. So it's not something I would suggest employers ignore, because if you do nothing, there will be NIC increases to both employees and to you as an employer going through April 29.
Okay, but as you said, we've got 3 years to think about this. Where do we go from here, Stephen, on all of this?
I'm a big fan of Douglas Adams and the Hitchhiker's Guide to the Galaxy. So that first bullet point there is don't panic, or in other words, keep calm and carry on. Mm-hmm. These changes are 3 years away. But absolutely do not close down any of your salary sacrifice arrangements for the foreseeable future, because they remain the most tax and NIC effective way to save for an employee's retirement. So yes, don't throw the baby out with the bathwater because these changes have been announced. That said, now is the time to start thinking about modelling what that financial impact would be. So yes, it is a few years away, but look at what the NIC hit will be to you as a business if you switch off the salary sacrifice, or if you revert to perhaps the pre-existing state where it wasn't via a salary sacrifice, but that has other consequences, because then individual employees, particularly the higher earners, they might not be able to claim what's called the top slice relief through payroll anymore, and they have to complete election via self-assessment. So there are still some benefits to salary sacrifice, albeit that you get that top slice savings. So think about reviewing your existing arrangements, work with your payroll, your people and culture, and your pension providers to understand what's the best way forward for you, and think about how that sort of feeds into both your reward and your comp strategy, because pension is such a key part of the benefits offering that you have. It's a compulsory requirement as well because of the auto enrolment rules, which is why I was always of the opinion that this might not come in, because politically it's quite sensitive. We're all living longer and not saving enough. So salary sacrifice and provision to allow effective savings to come through in the pension and the tax system was always considered a positive thing. But I suppose it's got to the point where it's not sustainable anymore in terms of the nick that Treasury felt they were losing. But think about, as I say, modelling and doing those impact assessments, consulting with relevant specialists early doors, and I suppose just looking into my crystal ball for a moment, that these changes are mooted to come in April 2029. The earliest there can be a general election, or the latest there can be a general election under the Fixed Term Parliament Act, is August 2029. Given that there have been some delays in introduction on other employment tax measures, whether that's payroll and benefits, that was delayed by 12 months. IR35, you'll remember that was delayed by 12 months. If this measure, which has proven to be quite unpopular in certain business groups and committees that I sit on, if this was delayed by just 12 months, it pushes this into the next election cycle. So this is happening right at the end of this current parliament. So it wouldn't surprise me at all if this does get kicked down the line or it becomes a successive government. But that said, don't ignore it, but don't panic, because at the same time, think about modelling. But for the time being, I would just keep things as they are. If you don't have a salary sacrifice as well, there is nothing to stop you implementing one for the next couple of years and crystallising some of those NIC savings, because you can still do that. And by crystallising those savings, you will actually buffer and offset what the NIC hit will be from April 29. So any of those issues chime with you, want to sort of discuss with me or my colleagues, by all means reach out, and the contact details are on the slide deck. But I'm sure that's probably about enough tax and pensions for you, and I'm conscious there's a lot of other announcements to get through in terms of the budget yesterday.
Okay, let's crack on then and talk us through some of the other, albeit I think less significant measures.
Yes, and I didn't want to ignore these other measures because there were a few others, but these aren't as significant as the pension ones. But the first one here is really a remnant from the days where all of us worked at home during the various COVID lockdowns. But there is a deduction that has been available for relief for income tax purposes for non-reimbursed home working expenses. So that means you claim the deduction yourself against your income by filling in either a deduction on your self-assessment or a form called a P87. So it's not reimbursed or provided by your employer. It's something you claim yourself. That is being removed from April next year. So just something to bear about if you do work from home regularly. There are some new measures to bring into pay as you earn an employment income. The treatment of certain shift patterns for employment rights purposes. It's called Section 27. So if you've got a payment for a shift cancel order, it's been moved or curtailed. At the moment, that isn't technically subject to employment income. This is being tweaked in the finance bill that's coming through to Parliament soon. So that from April 26, those types of payments will be taxable. And the final one here is if you've ever received payments for things like eye tests or flu vaccinations, there's always been a view that if those costs are met by the employer, it isn't considered taxable. But if the employer reimburses you those costs and you've incurred them themselves, certain perhaps overzealous inspectors from HMRC always try to assess that as PAYE. That's being fixed in the finance bill. So whether it's either reimbursed or met, those types of costs, home working, flu or eye tests, are no longer to be brought within the charge of PAYE, which is a positive development.
Okay, and a few other points.
Yeah, a couple of things here on cars. So there's a temporary easement relaxation around electric vehicles, the plug-in electric vehicles. So due to the new emission standards, if they hadn't introduced this easement, there would be an increase in benefit in kind tax for those types of vehicles. There's going to be an easement there until April 28 to sort of soften the blow around the new emission standards. So that's welcome, particularly if you've got an electric car and it's a company car. The employee car ownership schemes, these aren't technically salary sacrifice, but often known as ECOS schemes, where the employee effectively takes out a loan with a third party fleet provider for a car. This was closed down at the budget last year. It was going to be effective from April 26. That's now been delayed. See my previous comment about delaying these measures until April 2030, just to allow more time for the sector to prepare and adapt, because a lot of these are electric cars and there's lease tie-ins. So that's welcome as well. We have a bit more time. Final bullet point for me, and this is, I suppose, linked a little bit to that point around emigration and Neil's clients queuing up at Heathrow Airport. But from April 26, the ability to make voluntary Class 2 national insurance contributions while you're living or working abroad, that's going to be removed. So previously, you'd only have to be employed or working here for 3 years as a minimum. Then you could move overseas and make these voluntary, albeit quite small contributions. But by doing that, you'd maintain an entitlement to the UK state pension. That 3-year limit is actually being increased to 10 years. So you've got to be living or working here for 10 years minimum before you can make those contributions. And going forward, it will be Class 3 contributions, which are higher than the Class 2 ones. So that's coming in from April 26. So something to bear in mind if you're currently making those or know of anyone who's making those and they haven't been here for a while.
All right. Thank you very much.
Thank you.
Let us now talk briefly about trusts, Neil. Not too many changes here, I think.
No, and I won't dwell on this too much, but for those where trusts are relevant or you're advising clients with trust interests, I'll just run through some of the more general changes. So employee ownership trusts, these are the entities that in theory can be established to sell your business to, if effectively a bit like an EBT in some respects, where employees are the beneficiaries. Historically, and since this legislation was introduced, where you sell your business to an EOT, the capital gain was exempt, and typically the consideration would be payable over time from cash flows generated within the business. Effectively now, only half of your gains will be exempt, so the relief has been cut from 100 to 50%. And what that really means is that you'll have a 7% effective tax rate on the first 1 million, on the basis that you're quite likely in most cases to get business asset disposal relief prior to April 26, with the balance being liable at 12%.
Still not bad, is it, Neil?
Rate of tax. It's still not bad, but you've got to bear in mind that you have to have that initial cash flow to take tax when the business is sold. And if that initial cash flow or that lump sum isn't there, it's effectively a dry tax charge for those selling to an EOT. So in general, this may make it a bit more marginal in some cases as to whether an MBO is more appropriate. And as one colleague said yesterday, and I agree with, it will probably make employee ownership trusts used for in the right cases, and probably in those circumstances where they were originally intended to be used. I think it's fair to say that there's been a lot of EOTs set up in the last few years, and there's been a number of cases now where it's quite clear that it wasn't wholly appropriate for those types of businesses to go through that sales structure. But anyway, moving on, just a very quick note on discretionary trusts. The trusts pay tax broadly like individuals, but the trust rate of income tax will increase from 45 to 47% in line with some of the changes that we mentioned earlier, where property and savings income is concerned. Dividend income has always been taxed in a trust at the highest possible rate, additional rate, so that rate will remain at 39.35. And that does mean that the notional tax credit that you're generally treated as being receiving on a net distribution of cash will increase, and we've noted what those will be going forward.
Okay, thank you.
So the cap on inheritance tax for historic excluded property trusts. So excluded property trusts were typically trusts that were held or established by non-domiciled individuals. They are now, as a result of the changes to the non-domiciled tax regime and the corresponding changes to trusts, they're now within what we call the relevant property trade regime that almost all UK trusts are subject to. And what they've done really is place a cap on any exit charges, so effectively on any capital distributions from trusts, and the 10-year annually charged to inheritance tax that trusts like this are subject to, and that cap will be at 5 million. So effectively, by my calculation, the trust would need to be worth around 83 million before you would start to see a benefit from this change.
Blimey. Okay.
There's a few anti-avoidance rules that will be introduced. I won't dwell on these too much, but broadly, what most of these rules are trying to do is stopping you from recategorizing something as being a UK versus a non-UK asset, depending on your circumstances, or a non-business asset and converting it into a business asset immediately prior to one of the above charges. In the period before the charge arises. So that is something that you're able to do historically, and some of these rules will make that far more difficult, if not impossible, to do going forwards.
Okay, and probably, I guess we'd say, fair enough. Now you've touched upon IHT there, which was, fair to say, fairly political and divisive last year. There's been a few other changes this year, nothing as major, but just want to give us the headlines there, Neil.
Yeah, so obviously we had the biggest change to inheritance tax. That came last year from April 25. So inheritance tax exposure is no longer based on domicile. It's now effectively based on residence and whether you're a long-term resident of the UK or not. Equally, we had our business property relief changes, which, if enacted, will mean that shares in qualifying trading companies and qualifying farmland and agricultural property will have their relief cut to 50% from 100% from next year. The inheritance tax was one of the biggest causes of concern in this budget. There obviously have been rumours that the 7-year gift regime might increase to 10 years or more, that there might be a lifetime cap on gifting, and various other reliefs may be removed. That didn't happen. For what it's worth, I didn't expect it to, but given the rumours, this was a huge concern for clients. It's been very high on clients' agendas of things to discuss. So a big sigh of relief for most clients yesterday when this didn't happen, but there were some minor tweaks. They are now allowing the 1 million allowance for agricultural property relief and business property relief to transfer between spouses. And that 1 million allowance is the allowance that you are able to get post April 26 if the legislation's enacted, that gives you 100% relief on your first million of business property relief or agricultural property relief. So that will be transferable, and that will apply even if the first death occurs prior to next April. There were some inclusions in relation to pension death benefits. It's been very clear since the legislation was tabled that pensions will become subject in general to inheritance tax from April 27. That pensions will be liable to pay the tax as an entity themselves. I think they'll file their own return as such, and executors, personal representatives can instruct a pension scheme administrators to withhold 50% of taxable benefits for up to 15 months. And there was a nuance in there that I think effectively absolve personal representatives from personal liability if they discover historic pensions that they weren't aware of when going for probate and filling out the relevant forms.
Okay, and just another couple of points before we wrap up on IHT.
Yeah, I won't go into the infected blood compensation scheme, but there was a mention on that yesterday, and the ability to gift compensation without incurring IHT. So that is relevant to anyone there, and definitely read those few bullet points there. Also, some anti-avoidance measures for agricultural property. So as many listeners will know, real estate has been chipped away at over the last 15 years, whether it be non-resident capital gains tax, interest relief, capital gains tax rates for residential property more generally. We now have property-rich company rules. It really has been a terrible 15 years for anyone owning real estate from a tax perspective in this country. What they have now said is that where you own agricultural property through a non-UK entity, whatever that entity may be, in general, that will be it will be treated as a UK situs asset going forward. So even if you hold agricultural property via a non-UK holding company, you'll be treated as having a UK situs asset. That leads to the more broader question of, will commercial property eventually fall within a similar regime? And the answer to that is probably at some point. That would seem to be the logical progression for me in direction of travel, but we'll see. And then there are some anti-avoidance measures around charities' lifetime gifts and gifts on death that will kick in between yesterday and the 6th of April.
Okay.
Just to avoid you trying to fall out of that new regime.
Okay. So last year we also had some hikes in CGT. Not much to say really this year, was there, Neil?
Yeah, and funnily enough, everyone hypothesises usually that capital gains tax rates are going to increase. Bizarrely, this was one of the few rumours we didn't really have to any great extent in this budget, which was interesting, particularly given where rates are. It would have been a bit unusual given that they'd reduced rates at the last budget from 28 to 24, but nevertheless. So the headline rates remain unchanged. I've already mentioned that the employee ownership trust relief has been halved. There's a funny nuance that's been included in the legislation, which we definitely need to give some more thought to, around share reorganisation. So this might apply, for example, where you insert a holding company above an existing structure, or you look to restructure your existing interests. You can often do this in the legislation in a tax neutral way, and typically if you obtained clearance from HMRC, that would have had to been on the basis that you didn't have a tax avoidance motive to that, and that there was a commercial rationale. As my reading of the legislation is that commercial rationale test has been removed. The other interesting nuance is when you actually read the draft legislation, it refers to reduction or avoidance in tax. So what this is probably going to do is really put the spotlight on whether there is a motive for a reduction or avoidance in tax with HMRC going forwards, whereas previously there was more of a focus on whether there was a commercial motive that made an incidental potential tax saving justifiable. So that is something we are going to have to give some serious thought to, even potentially in some of the more benign situations.
Yeah, and they've said if you were granted clearance before the budget, effectively that's only good for 60 days. So we'll need to look at that, and we're waiting the full details on that. And none of this, of course, deals with the fact that the revenues interpretation seems to shift with time. So I guess we'll have to see on that. And then, of course, if anything of relevance comes out, we will try and publish some guidance to you all on our website. Okay, so that's capital gains tax. I guess over to me now. Let's talk about business tax, where again, it's primarily just tweaks, to be honest. If we start with corporation tax, headline rate is still 25%, still, I guess, relatively competitive. Interestingly, normally when they play around with the dividend tax rates, the rate of so-called Section 455 tax also moves. That's the tax that you pay, or a company pays up front when it makes a loan to a participator or shareholder. I've not seen anything that suggests that will move, and of course, because the higher rate on dividends remains at 39.36%, maybe it will stay, but we'll keep an eye on that. And then there's been some tweaks, transfer pricing, some changes. Helpfully, UK to UK transactions are now going to be exempt from transfer pricing, we're pleased to say. In reality, HMRC have given it a pretty light touch in the past. For permanent establishments, we're going to align our domestic legislation with the OECD Model Convention. So I think that's helpful. And that darn diverted profits tax is to be reformed. In fact, it's been replaced and effectively subsumed within transfer pricing. And that was always the principle. Were you artificially diverting profits outside the UK? If you were, then I think we can all see why probably transfer pricing is a good place to start. There's also a change on where you have a UK-based investment manager for an offshore fund. Does that give rise to a UK permanent establishment? There is some protection designed to protect jobs in the city here. There's going to be some revisions to the statement of practice there. Some administrative changes to the corporate interest rules. I think we'll save that one for another day. And the only other point I think we'd flag up at this point, there is to be a doubling of those flat rate late filing penalties for corporation tax, where the return is due for filing on or after 1 April 2026. To be fair, corporation tax self-assessment was introduced, I think it was 1999, if I'm correct, and the penalty there was £100. It's still £100. So I guess, okay, if it's 200 now, we'll just have to live with that, albeit they can go up to £1,000 if you repeatedly file your return late. So that will double to a slightly more painful £2,000. So that's that on corporation tax. Again, just a few minor changes here. There's a new 40% first year allowance to be introduced for so-called main pool expenditure. That's your plant machinery, otherwise, and sort of fixtures and fittings embedded in the building as a general rule. So a 40% relief for expenditure after 1 January 2026. In reality, most businesses will continue to benefit from the annual investment allowance, or if you're a company, for so-called full expensing that gives you 100% write-off. So there are a few cases where that 40% may be helpful. I think leasing assets, for example, and as we said, they're unincorporated businesses, but not too much to write about home. And from April 2026, the writing down allowance in the main pool is to reduce from 18 to 14%. It keeps going down, that one, but there you go. In reality, most businesses have always been claiming a full write-off. So those are the capital allowances changes. There are also some changes for employee share incentive schemes. The best deal by far is the enterprise management incentive, and we've done webinars on this before. So the good news is the employee limit increases to 500. That's doubled. The gross asset limit, so the size of business that can issue EMI options, that's also increasing to 120 million. Likewise, the value of the options that the company can have under option increases to 6 million. I think that's measured at the time the options are issued. One other change, previously your options could only run for up to 10 years. That's to be increased to 15. And all of this is expected to apply, of course, all subject to new normal finance bill tweaks, etc., from April 26. And in a welcome simplification, well, every little helps, as they say, EMI notification requirements is to be abolished from April 2027. So like we've seen, and Steve and Neil have already alluded to, a lot of these changes are being kicked down the road. So just one to keep an eye on. What if you are investing in a company, though? There is the pretty generous enterprise investment scheme that we'll start on that does allow you income tax breaks on your investment in relatively high risk and new businesses. Again, a doubling in many cases of the limits here. The annual company investment limit is raised to 10 million, or if you're a knowledge intensive company with the most ridiculously complex definition, that rises to 20 million. As far as a lifetime limit goes, so how much can a company seek overall, that's also doubled to 24 million and 40 million if you are knowledge intensive. Again, there are limits on the gross assets that the company can have at the time of the investment. That is now going up to 30 million before the share issue and 35 million after. Again, all of this applies from April 2026. Venture capital trusts also benefit from a similar doubling of investment limits as above, but unfortunately the VCT income tax relief rate is to be reduced to 20% again from next April. So not particularly great news that last one, albeit we don't see too much on the venture capital trust side of things, but on EIS, all positive. No changes to the seed EIS scheme, so those reliefs remain as they are. As always, as my colleague Helena always tells me, and a shout out to her parents, who were the first people to sign up for this webinar. So thank you very much. Nice to have you on board. Always look at the anti-avoidance because the devil's in the detail. So the revenue have announced additional focus on disqualifying rogue directors, which, I guess we've not got too much sympathy for, and chasing of unpaid taxes. They know where you live. So there will be further resources ploughed into that. There's going to be enhanced powers tackling tax advisors who facilitate non-compliance from 1 April 2026. I guess fair enough. And strengthened powers in respect of promoters of marketed tax avoidance schemes. I think that boat has long since sailed and not been anything we have ever recommended, but there is to be a further tightening of the screw there. There also needs to be a fair amount of mischief, and Neil, you may be able to help me out here. Image rights. And again, I think this was all about turning income into capital and either selling for a capital sum or shifting payments offshore. The bottom line is HMRC don't like it. Any such payments, they say, are going to be brought wholly within the scope of income tax and NIC from April 2027. And a consultation. Go on, Neil.
Sorry, Tony. I think in general, this is something that the revenue have been arguing or starting to argue for some time anyway. So this is really just putting their general position into legislation.
Yeah, no, I think that's fair enough. And finally, just to flag up a consultation on reporting transactions between close companies and shareholders. I think the revenue's view, it's always been a little bit too cosy. There are going to be additional disclosure requirements where you take dividends from close companies, aren't there, Neil, going forward? So we'll see what further comes out of that. Time marches on. If you could keep your sarnies warm for an extra 5 minutes. Neil, do you just want to give us the headlines here? Loan charge, very emotive issue, I think it'd be fair to say. A welcome, perhaps, opportunity here now to put this to bed.
Yeah, potentially. I mean, if we just cover very quickly what the loan charge is, it was introduced as an anti-avoidance measure in general to address the loss of tax from a variety of disguised remuneration schemes, often involving EBTs, where individuals took their remuneration or were paid in the form of loans as opposed to paying salary. And usually these loans weren't paid by the employer as a result because there was an entity like an EBT involved. Effectively, there will be a new settlement opportunity, as we've outlined here. But for those taxpayers that haven't already settled settled their scheme with HMRC and come to an agreed assessment, or even have outstanding assessments, their position could be very significantly changed by the review. So if this does affect you, get in touch, because it will be a limited time. You will only have a limited time to act.
Okay, thank you. Right, we'll talk a couple of minutes on property and then we'll just wrap up on VAT. So property keeps getting hit. I mean, we've had, if we look back over the past few years, removal of furnished holiday lettings and wear and tear allowances. Multiple dwellings relief was quite painful from an SDLT perspective, and the restriction on interest relief, I guess, was one of the major changes. We've already flagged up the 2% additional income tax charge. So just to say, you might want to consider incorporating that business. That does come with its own consequences. There was another little tweak announced yesterday, and that was that if you claim incorporation relief, then it's no longer an automatic relief that you can opt out of. Now you have to elect into the regime. So just a point to be aware of. So for considering incorporation, some people, as Neil, I think, alluded to earlier, may be considering just throwing in the towel and divesting here. And of course, if you do incorporate, then to get the money out, all the points we talked about before, the additional 2% on dividends. So no easy answers on any of that, but we do specialise, and my colleague Andrew Levine, who's our Director of Property Taxes, can advise if you have a property portfolio and wish to consider incorporation. There's also the so-called mansion tax. Well, okay, from April 2028, it's some way off. This will be a high-value council tax surcharge on properties worth more than £2 million. There's a £2,500 charge if the property is worth more than £2 million. and it goes up in steps to 7,500 for properties valued at more than 5 million, and will of course increase over time. So we are going to have a valuation exercise to identify that. The charge is going to be levied on the occupier on the owners rather than the occupiers, but I guess the question is, will that just be passed on? Inevitably, though, this is going to particularly hit people in the southeast, but there will be a consultation, particularly where you are so-called asset rich and cash poor, whether the tax charge can be rolled up. So watch this space. And all I'm going to say on business rates, I think, as Rachel Reeves said, they're trying to shift the burden from smaller businesses to larger businesses and provide additional help and support to the retail, hospitality and leisure sectors. So a few more details on the slide, but I think that's all we'll say for now. So finally, as the clock just comes around to 2 o'clock, just 2 minutes on VAT, which I believe is 20%. So I'm only going to cover this at a very high level. So what was announced on VAT? Well, there is to be a zero rate of VAT on eligible donations to charities by companies. So you can see the point. They're trying to encourage corporate donations. I think that is all welcome news. That will apply from April 2026. And apart from that, the only other point I think of significance to mention is that if you have a UK branch of an overseas company and that UK branch is part of a UK VAT group, there are a few changes here. If that's relevant to you, please speak to our VAT team, Luigi, Simon, Malcolm, and the rest of the team, who would be happy to advise you further. I'm not going to cover the next couple of slides. They will, as I say, be sent out to you. But I think all I'm going to say is thank you very much to my colleagues, Stephen and Neil. Really appreciate your time and your input and your thoughts today. Thank you, it goes without saying, to the hardworking team behind the scenes. There's been lots of you doing lots. I'm not going to embarrass you by turning your cameras on. I was tempted, but thank you, Lola, Maz, and all the rest of you, David, who does a wonderful job proofreading everything, and the rest of the marketing team for all your support. If you'd like further details, there's loads of help and support on our website. Have a look. There's a website there. There's a further deep dive into many of the provisions. Neil, I think you're doing a second webinar on this on the 2nd of December, when we'll be looking at more of these measures in further details. Oh, a round of applause there. And if you are young, you will no doubt know what that QR code is and what to do with it. But have a look, as I say, on our website for further details. So that's it from us. Thank you very much. Thank you for joining us, and we do hope to see you all soon. Neil, Stephen, I think our work here is done. I've booked us the cab to the airport and to Heathrow. We're on our way, but thank you all for listening to our It Could Have Been Worse budget seminar. Thanks all. Goodbye now.